There is a report that can be filed about your bank account with your name on it that you are never allowed to see. You will not be told it happened, you cannot request a copy, and the employee at your own bank who knows about it is legally forbidden from telling you. Verified card. Source: Bank Secrecy Act prohibits financial institutions from disclosing the filing of a suspicious activity report. That is not a conspiracy theory. That is federal law, and it has been on the books for decades. Now here's the part that matters for you. Most people believe there is one number that triggers all of this: $10,000. Cross it and you are reported. Stay under it and you are invisible. That is wrong, and believing it is how honest people get themselves into trouble. Because the report everyone worries about is the harmless one, and the report nobody has heard of is the one that has no dollar threshold at all. Verified card. Source: Suspicious activity reports have no minimum dollar amount. None. It can be filed on $800. It can be filed on $200. It is not triggered by an amount. It is triggered by a pattern. And the single most common way an honest senior creates that pattern is by trying to be careful. I want to say that again because it is the strangest sentence in this entire subject. The caution is the trigger, not the money, not the amount, the act of being careful about the amount. There are people in this country who have had their accounts reviewed for one reason only. They heard about a rule, they got nervous, and they tried to stay tidy. Every one of them would have been completely invisible if they had simply done nothing at all. And there is a reason that particular mistake is so widespread right now. The $10,000 figure is everywhere. It is in headlines, in videos, in conversations at church and across kitchen tables. So millions of people know that a number exists, and almost none of them know what it actually does. They know enough to be nervous, and not enough to be safe. That is the worst possible amount of information to have about anything, and it is exactly the amount most people have about this. Now stay with me because there is one more thing. The people who never get flagged are not doing anything clever. They are not hiding anything, and they are not using a loophole. They have simply arranged their money in a way that gives the system nothing to look at. Before this video ends, I will show you exactly what that arrangement looks like. My name is Kevin. Every week I go looking for the rule that quietly decides what happens to your money, and I bring it here before it costs you anything. If that sounds useful, subscribe and turn on the bell because this particular system is running on your account right now, whether anybody told you or not. Let me start with what is actually being watched, because almost everybody has this backwards. There are two different reports. They are nothing alike, and people confuse them constantly. The first one is the currency transaction report. When a cash transaction crosses $10,000, your bank files one, automatically. Your name, your identifying information, the amount, the date. Verified card. Source: Bank Secrecy Act currency transaction reporting requirement for cash transactions over $10,000. Now here is what I want you to hear clearly, because the internet has this exactly backwards. That report is routine. Banks file enormous numbers of them every single year. It is a record, not an accusation. Nobody investigates you because one was filed. Nothing happens. You will very likely never know. 50, that is the report everybody is afraid of, and it is the one that should worry you least. 50, and there is one detail about it worth knowing because it clears up a lot of confusion. It applies to cash, physical currency moving across a counter. Verified card. Source: Currency transaction reporting applies to transactions in physical currency. 50, a check does not trigger it. A wire does not trigger it. A transfer between your own accounts does not trigger it. Which is why somebody can move a very large amount of money electronically and never think about this once, while somebody depositing a modest amount of cash from a car sale worries for a month. The rule was never about the size of your wealth. It was always about the form the money arrived in. 50, and there is a piece of history in that number that explains a great deal. That $10,000 figure was set decades ago, and it has never been adjusted for the fact that prices have risen enormously since then. Verified card. Source: The currency transaction reporting threshold has remained at $10,000 since it was established. Think about what $10,000 represented when that line was drawn, compared to what it represents now. It was meant to catch unusual, serious money. Today it catches a used car, a roof, a modest inheritance. Nobody moved the line closer to ordinary people. Ordinary people simply drifted up into it, 1 year of price increases at a time. Which is why so many perfectly normal transactions now brush against a threshold that was never designed with them in mind. Now the second one, the suspicious activity report. This one has no threshold. There is no dollar amount that triggers it and no dollar amount that keeps you safe from it. Verified card. Source. Suspicious activity reports may be filed on transactions of any size. A bank's monitoring software watches your account continuously. It is looking for activity that does not match your own history. Not activity that is large, activity that is different from you. And when it decides something looks unusual, a report can be filed, and it goes into a federal database, and it stays there for years. Verified card. Source. Suspicious activity reports are retained in a federal database. Confirm current retention period before recording, and you will not be told. Not because your bank is hiding something from you out of malice, because telling you is a federal crime. Verified card. Source. Federal law prohibits notifying a customer that a suspicious activity report has been filed. That prohibition exists for a real reason. If banks warned people, actual criminals would simply adjust. But the effect on an ordinary person is strange and worth naming plainly. Something can be recorded about you in a government database, and every person who knows about it is legally required to say nothing. Now let me show you how an honest person walks straight into one. Elwood is 74. He lives outside Zanesville, Ohio. He spent 31 years driving a fuel truck. After his wife passed, he sold her car. A neighbor's son bought it for a little over $9,000 in cash, which is how that kind of sale often happens. Now, Elwood had heard about the $10,000 rule. Everybody has heard about the $10,000 rule. He was under it, but not by much, and it made him uneasy. He did not want any trouble. He did not want a form with his name on it. So he did what felt like the careful, responsible thing. He deposited part of it on a Tuesday, the rest on a Friday. 2 smaller deposits instead of 1 larger one. He thought he was staying tidy. What he had actually done has a name, and the name is structuring. Verified card. Source. Structuring transactions to avoid currency transaction reporting is a federal offense. And here is the sentence that catches good people. It does not matter that the money was legitimate. It was his wife's car. He had the title. Every dollar of it was clean and his. That is not the question the law asks. The law asks whether the transactions were arranged to stay under a reporting threshold. And here is what makes it worse. You do not have to know the threshold exists for the pattern to look like avoidance. A monitoring system does not read intentions, it reads shapes. 2 deposits, close together, both landing just under a well-known line, in an account that has been perfectly predictable for years. That is a shape. And the shape can be built in ways people never consider. 2 people in one household, each making a deposit on the same day at the same bank, each one under the line. To them, that is 2 errands. To a monitoring system, that is 1 household and 1 pattern. Mana or different branches of the same bank on different days, which people sometimes do thinking it separates the transactions. It does not. It is 1 institution and 1 account, and moving between branches is itself a thing the software notices. Mana, I am not telling you this to make you afraid of your own bank. I am telling you because every one of those is done constantly by people with nothing whatsoever to hide, for reasons that have nothing to do with any threshold. The safe path is always the same, and it is always the simplest one. 1 transaction, the full amount, with the paperwork in hand. Mana Elwood was never charged with anything. Almost nobody in his situation is. But weeks later, a deposit he had received on the same day of the month for years was placed on a hold. No letter, no call, nothing to explain it. He found out when an automatic payment failed. And think about what a hold actually does to a household on a fixed income. It is not 1 inconvenience. It is every automatic payment at once. The insurance draft fails, the utility payment bounces, and every one of those failures brings its own fee, from the bank and from the company on the other end. By the time the hold lifts, the hold itself has cost real money that nobody gives back. That is the true price of this for almost everybody. Not a criminal case. A week of bounced payments and a stack of fees over money that was always yours. And that is the actual cost of this for most people. Not handcuffs, not a courtroom. A hold, at the wrong moment, on money you were counting on, with no explanation available and nobody able to tell you why. So let me give you the rule that would have saved him, and it is 1 sentence. Deposit it whole. If a large amount of cash comes into your life, put it in as one transaction. Let whatever paperwork the bank has to do happen. That paperwork costs you nothing. It takes no extra time. It is filed and forgotten. Splitting it up to avoid the paperwork is the only part of that entire situation that can actually hurt you. And bring the proof with you: a bill of sale, a copy of the title, a settlement letter, verified card, source. Documentation of the source of funds helps resolve questions about large deposits. Because a written explanation ends a conversation. A verbal one just starts a longer one. Elwood's story is the one I keep coming back to, because of how close he came to doing it right. He knew there was a rule. He was trying to respect it. And the exact thing he did to stay out of trouble is the thing that created it. Nobody had ever told him the one sentence that mattered. Not the bank, not a letter, not anyone. That gap is why I put together the Quiet Rules. It is everything I cover on this channel in one place, written large and written plain. What actually triggers a review and what does not. What to do the day a large amount of money arrives. What to keep and what to say and what never to do. So that the person standing at a counter with a check in their hand already knows the answer, instead of learning it 8 weeks later when a payment bounces. The paper remembers for you. That is the whole point of paper. You can find it at kevinexplains.shop. The link is right below this video, or scan the QR code on your screen right now. It is also in the pinned comment at the top. And there is a 7-day guarantee. Always. If it does not hand you something you did not have before, you send it back. Because the alternative is a widower who sold his wife's car, tried to be careful, and lost weeks of peace over it. If nobody has ever explained the difference between those two reports to you before today, do me one favor. Subscribe and turn on the bell. Because this channel reads the fine print that nobody mails to your house. Now let me get to the second half of this, because deposits are not the only thing being watched. Your balance is being watched too. And this is the part almost nobody knows. Banks build a profile of what normal looks like for you specifically. Your income, what comes in, and how often, and from where. What goes out, what your balance usually sits at. That profile is the baseline, and once it exists, the system is not asking whether an amount is large. It is asking whether it is large for you. And that is genuinely the most important sentence in this video, so let me make it concrete. A person who runs a small business through their account, with money moving constantly in both directions, can deposit a large amount and nothing happens at all. That is Tuesday for them. A retired teacher whose account has received the same 2 payments on the same 2 days for 11 years can deposit a fraction of that amount and get a second look. Same bank, same software, completely different response, not because one of them is more trusted, because the system is measuring each of them against themselves, which means the more regular and predictable your account history has been, the more a single unusual event stands out. Stability is a wonderful thing to have, and it is also, in this one narrow way, what makes an exception visible. Which is why 2 people can make the identical deposit, and only one of them gets a second look. For someone whose account regularly moves large amounts, a big deposit is normal. For someone whose account has held the same steady rhythm for a decade, the same deposit is an anomaly. And it works on the balance itself, not just on transactions. A balance that sits far above what your income would explain for a long time can look unusual on its own. Verified card. Source. Automated monitoring evaluates account activity and balances relative to a customer's expected profile. Now I want to be very clear about something, because there is a lot of nonsense on the internet about this. There is no law that says you cannot keep a large amount of money in a bank account. None. You are allowed to keep whatever you want. Anybody telling you there is a legal limit is making that up. And you will see that claim constantly, usually with a very specific number attached, which is what makes it convincing. Do not keep more than this exact amount. It sounds official. It sounds like somebody read a regulation. Busha, there is no such regulation. Nobody has ever passed a law capping what an American may keep in a bank account. What there are reasons of your own to think about where money sits. Insurance coverage, interest earned, concentration risk. Those are real, and I am going to walk through every one of them. But none of them is a legal ceiling, and anybody presenting a number as the law is selling you certainty they do not have. Busha, what is true is much simpler, and it is about concentration. Busha, if everything you have is in one institution, then one flag, one review, one hold reaches everything at once. Your checking, your savings, your certificates, whatever else is under that same roof. Verified card. Source, a review at one institution may affect multiple accounts held at that institution. And that is the real reason not to pile everything into one bank, not a legal limit, a single point of failure. Lee, let me tell you what that looks like when it happens. Delphine is 69. She lives in Chillicothe, Missouri. She taught third grade for 26 years. When her husband died, his life insurance paid out. It went into the same account she had used for everything since the 80s, because that is where money goes. That deposit was enormous compared to everything that account had ever seen, a pension and a Social Security payment month after month for years. Then, in one afternoon, a sum many times larger than anything in her history. The system did exactly what it was built to do. It noticed. There was a review, and the review did not confine itself to the new money. Her checking, her small savings, all of it was under the same roof, and all of it was inside the same review. She had just buried her husband. She had a funeral bill, a headstone, and a lawyer, and for a stretch of days she could not move her own money while a process she was not allowed to see ran its course. And nobody did anything wrong to her. That is the part that is hard to sit with. The insurance company paid correctly. The bank followed its own procedures correctly. The software did what it was designed to do. Every individual step in that chain was reasonable, and the result was a grieving woman standing at a counter unable to pay for her husband's headstone. That is what it looks like when a system that is working as intended meets a person it was never designed around. And I want to give you the second half of Delphine's story because it did resolve. The review finished. The money was hers. It had always been hers, and the documentation was flawless because a life insurance payout comes with paperwork attached. But it took the days it took, and nobody could tell her in advance how many days that would be. That is the part worth planning around. Not whether you will eventually get your money, you almost certainly will, whether you can survive the stretch in the middle without access to it. A second account somewhere else turns that stretch from a crisis into an inconvenience. Now here's the part that would have prevented all of it, and it takes one phone call before the money arrives. If you know a large sum is coming, you can open an account somewhere else and have it sent there. Not to hide it. There is nothing to hide. Simply so that the arrival of that money, and any questions it raises, happens somewhere separate from the account that pays your electric bill. That single decision keeps your daily life running no matter what happens with the larger sum. And a life insurance payout, a pension lump sum, an inheritance, a home sale, every one of those is something you almost always know is coming in advance. Which means this is one of the rare problems in this entire subject that you can solve completely before it ever exists with a phone call. Now let me tell you about Bertram, because his version of this is the one most people are actually walking around with. Bertram is 77. He lives in Enid, Oklahoma. He sold a small farm implement business years ago, and he is careful with money in the way that generation is careful. He keeps almost everything in one bank, same bank since the 70s. He knows the branch manager. He likes it that way, and I understand why. Bertram was never flagged for anything. Nothing happened to him at all. The problem with Bertram is not what happened. It is what would happen. Because if that one institution ever placed a hold on his relationship for any reason, including a mistake, he has nothing outside it. No second account to buy groceries from. No separate place his automatic payments could draw on. Nothing. And there is a second thing about Bertram's setup that has already been costing him money, quietly, every single year. Actually, there are two, and I want to name the other one first because it is larger than most people think. Money sitting in a low-interest account is not standing still. It is shrinking. If your money earns almost nothing while prices rise, then every year that balance buys less than it did the year before. The number on the statement never changes, so nothing looks wrong. Source: cash held in low-yield accounts loses purchasing power when inflation exceeds the interest rate. That is the quietest loss in personal finance, because there is no fee, no notice, and no line item. The account simply becomes worth less while looking identical. For somebody holding a large balance in one old account at a very low rate, that erosion over a decade can dwarf anything else in this video. Deposit insurance covers a set amount per depositor, per institution, per ownership category. Verified card. Source: FDIC deposit insurance limits apply per depositor, per insured bank, per ownership category. Confirm current coverage amount before recording. A person keeping everything in one bank can, without ever thinking about it, hold more than what is covered. And that is not a monitoring problem or a flag problem. That is a straightforward exposure that costs nothing to fix and that almost nobody checks. So, there are 3 separate reasons to spread money across more than one institution, and only one of them has anything to do with being watched. 1. A review at one bank does not reach the others. 2. Deposit insurance is per institution. 3. Money sitting idle in a low-interest account is losing value every year to rising prices, whether anybody flags it or not. Now let me give you the 3 moments when this goes wrong for people, because they are predictable. The first is a required distribution from a retirement account. Once those begin, a large sum arrives on a schedule, often much larger than anything else that moves through your account. If it lands in your everyday checking account, you have created the exact spike we have been talking about, on purpose, every single year. The second is a lump sum from a pension. Those can be very large, and they usually arrive once with plenty of notice. The third is a payout after a death. Life insurance, a settlement, and estate distribution. Every one of those 3 is known in advance. Not one of them is a surprise, which means every one of them can be routed somewhere appropriate before it ever arrives, rather than dropped into the middle of your daily banking and explained afterward. And there is a fourth that catches people who are not expecting it: selling a home. Downsizing is a completely normal thing to do in your 70s, and the proceeds are usually the largest single sum a person ever handles. That money is fully documented. There is a closing statement, a settlement sheet, an entire paper trail produced by professionals, which makes it the easiest large deposit in the world to explain, provided you keep the paperwork, and provided it does not land somewhere that disrupts your daily life for a week while it is reviewed. Same principle as the other 3. Decide where it goes before it arrives, and keep the paper that explains it. Now, the warning signs, because some of you are watching this and quietly recognizing something. Here's what it can look like when an account is under review. A deposit that has arrived on the same day for years is suddenly held for several days with no explanation. A teller steps away to speak with a manager over a transaction that never used to need one. A letter arrives asking you to verify identity or update information that has not changed in a decade. You are declined for something ordinary at a bank where you have been a customer for 20 years and nobody can tell you why. Or a letter says the institution can no longer serve your account. Verified card. Source: financial institutions may close customer accounts at their discretion. If one of those has happened to you recently, do not panic and do not go in demanding to know whether a report was filed. Nobody there is permitted to tell you, and asking puts an employee in an impossible position. What you do instead is practical. Make sure you have a working account somewhere else so your life keeps running. And gather documentation for every large deposit in the last year, where it came from and what it was, on paper. Because the single most useful thing you can hand an institution is a boring, verifiable explanation in writing before anybody has to ask you for it twice. And one more thing that changes how these conversations go. Ask your bank to add a trusted contact to your accounts. One name and one phone number. Verified card. Source. Financial institutions commonly offer trusted contact designations. That person gets no access and no authority over your money. They cannot move a dollar. They are simply somebody the bank is permitted to call if something about your account raises a question. It sounds small. It is the difference between an institution having to guess about you and having a way to check. A customer with a trusted contact on file, current documentation, and money spread sensibly across more than one place is a customer who almost never runs into anything in this video. Now let me pay off what I promised at the start. I said the people who never get flagged are not doing anything clever, and that is the truth. Here is what their money actually looks like. Their everyday account is boring. Predictable in, predictable out, a balance that makes sense next to their income. Nothing dramatic ever happens in it. Anything unusual, a payout, a sale, an inheritance, arrives somewhere else. Not hidden, just separate. Their money sits across more than one institution, so no single review can reach all of it, and so deposit insurance covers everything. And when something large does arrive, the paperwork explaining it goes into a folder the same week, while everyone still remembers what it was. That is the whole thing. There is nothing sophisticated in it. It is not a strategy for avoiding attention. It is what money looks like when somebody has simply organized it. And organized money is invisible to a system that is looking for chaos. And I want to say something about that word, invisible, because I do not want to be misunderstood. The goal here is not to evade anything. Nothing in this video is about hiding money from anybody. The monitoring system was not built to catch retirees. It catches them by accident, because they look unusual to a machine that does not know who they are. Every single thing I have described is about making your ordinary, legitimate, hard-earned money look exactly like what it is. If you want a second set of eyes on your own situation, whether your accounts are concentrated somewhere they should not be, or how to handle a large sum you know is coming, email me. The address is on your screen and in the description below. I read every one. There is one more thing I want to hand you before the checklist. Everything in this video comes down to knowing what to do in the specific week that something happens. The week the check arrives, the week the letter comes, the week the deposit is held. That is exactly what the Quiet Rules is built for. The steps to take before a large sum lands. What documentation to keep and for how long. What to say and what not to say when a bank asks a question. What the warning signs mean and what to do about each one. Written plain, in one place, so it is sitting in the drawer before the week arrives instead of being figured out during it. You can find it at kevinexplains.shop. The link is in the description and in the pinned comment at the top, or scan the QR code on your screen right now. 7-day guarantee, no questions asked. Because the alternative is what happened to Delphine, a woman with a funeral to pay for, locked out of her own money during the worst week of her life. Now here is your checklist. 5 things. 1. If everything you have is at one institution, open an account somewhere else this month. Not to move everything, just so a problem at one place cannot reach all of it. 2. Check whether what you hold at any single bank is inside deposit insurance limits. That takes 10 minutes and it has nothing to do with anybody watching you. 3. If you know a large sum is coming, decide where it will land before it arrives, not after. 4. If cash comes into your life, deposit it whole. One transaction. Never split it to stay under a number. 5. Keep the paperwork for every large deposit. A bill of sale, an estate letter, a settlement statement. Put it in a folder the same week while you still remember what it was. Here is what I want you carrying out of this video. Elwood tried to follow a rule he had heard about and created a problem by doing it. Delphine put her husband's life insurance in the account she had used her whole life, which is what anybody would do, and could not reach her own money to bury him. And Bertram has done nothing wrong at all. He simply has everything in one place, and has no idea what that would cost him on the day something goes sideways. Not one of them broke a law. Not one of them hit a dollar. Not one of them did anything a reasonable person would call careless. Every single one of them was pattern matched by a piece of software that has no idea who they are. That is the thing to hold on to. You are not up against a person who has judged you. You are up against a machine that does not know you. And the entire defense is to be boring, be separated, and keep the paper. Now, 3 words: boring, separated, documented. Boring means your everyday account looks the way it has always looked. Separated means one problem cannot reach everything you own. And documented means that when a question does come, the answer already exists on paper and takes 30 seconds instead of 3 weeks. But that is it. That is the whole video. Do the 5 things on that list this month while nothing is wrong, and this system will never look at your account twice. I am Kevin. Thanks for watching. Do not forget to check the Quiet Rules at kevinexplains.shop.